Please
Good
tell me
evening.
when I should stop.
Thank you. Good evening. I'll now call this meeting of the Standing Committee on Government Operations to order. To begin, would anybody like to provide a prayer, or does committee wish to forego the prayer? Seeing none, we will forego the prayer for now. Our next item is review and adoption of the agenda, which we will, does anybody have any additions at this time? Seeing none, can I have a motion to approve the agenda? Thank you, Mr. Rogers. Declarations of conflicts of interest. Seeing none, we will move forward. Tonight, committee will be continuing its statutory review of the NWT Heritage Fund Act and will be hearing from Professor Bill Megginson from the University of Oklahoma. The committee, if we are ready, we will begin the public briefing. I'm sorry, my script anticipated for things that were not in the public briefing, and we're just going to skip ahead. So good evening, my name is Kate Reed. I am the MLA for Great Slave and the Deputy Chair of this committee. Tonight's meeting is public and live streamed on the Assembly's social media channels. Before we begin, I would like to remind all members and witnesses to direct all comments and questions to me as chair, and please wait to be recognized before speaking. This helps keep the meeting run smoothly. And I will now ask members to introduce themselves, starting with members present in the room.
Thank you, Madam Chair. Welcome, Professor. Welcome, members of the public. My name is Denny Rogers. I am the MLA for Inuvik Boot Lake.
Thank you, Mr. Rogers. And with the members online, please introduce themselves.
Thank you, Madam Chair. Julian Morse, MLA for Frame Lake here in Yellowknife.
We do have one more member online. Ms. Waylon Armstrong, would you like to introduce yourself?
Yes, I do apologize. My name is Jane Waylon Armstrong. I'm MLA for Murphy Riding, Cleacher Region.
Thank you, Ms. Waylon Armstrong, and thank you, Mr. Morse. This evening, as part of our statutory review on the Northwest Territories Heritage Fund Act, we are joined by Professor Bill Megginson, Price Chair in Finance at the University of Oklahoma's Michael F. Price College of Business. Professor Megginson, can you please introduce yourself and proceed with your presentation? We will then proceed to questions from committee members. Thank you.
Thank you, Madam Chairman. I'm deeply honored to be here, and thank you for inviting me. Let me go ahead and start my share because I have an introductory slide there. I guess is probably the easiest way to do an introduction. It was interesting reading what I could find about the statutory, the Heritage Fund. It was relatively limited, but what I'll talk about tonight, basically, and I should take 15 minutes or so, is to provide an overview of sovereign wealth fund, what's happening worldwide today. I've been researching sovereign wealth funds for almost 20 years. As Madam Chair said, I'm the professor and Price Chair of Finance at the University of Oklahoma. I'm also a visiting professor at a Chinese University, Beijing University of International Business and Economics. And I'm a finance area editor for the Journal of International Business Studies. So what I'll be talking is beginning an overview of sovereign wealth funds, which of course your Heritage Fund is a sovereign wealth fund as well. So I'll be talking about its overall size, where their funding sources and what they invest, some of the trends that are going on in sovereign wealth fund investing and funding, briefly look at some of the research, academic research in sovereign wealth fund, and then conclude. So as an overview, these are collectively a very large group of investors. There are 181 of them, with by far the most important are about 15 or 20 that are over $10 billion each. Collectively, they have assets under management of over $13 trillion. A sovereign wealth fund is something that came about. It's been around since the 1950s. The first one was the the Kuwait Investment Fund, but they really came of age after 1990 and really after 2000. So most of the sovereign wealth funds have been started fairly recently. Technically, the criteria for a sovereign wealth fund is that it's a state-owned investment vehicle It's an investment fund. It's not an operating company. It's not a state-owned enterprise. It's wholly owned by a sovereign government, but it's separate, deliberately made separate from the central bank and the finance ministry to have political independence. It makes international and domestic investments in risky assets. And this is one of the distinguishing features that they don't invest just in riskless treasury bonds. They're in search of a commercial return, and they're a wealth fund rather than a pension fund. By that, we mean there's no individual person's name on the fund, whereas there is for most of our pension funds that we all belong to. It is in the owned by the citizenry and operated in their best interest. Um, it turns out that the largest funds are actually not sovereign governments, as the new territories is not sovereign government, but the biggest ones are the UAE funds, and there's 7 or 8 of them that are owned and organized at the Emirati level. But it's a handy tool, sovereign wealth fund. In the United States, the biggest one is the Alaska Fund, but as a handy tool, we'll call it sovereign wealth funds. 2/3 of these are funded by oil revenues, and the other third mostly by export surplus countries in Asia, and over 2/3 were started since 2000. So I guess I'll just keep going until somebody asks me to stop or raises their hand. But please, I'm happy to answer questions, but my understanding that will be at the end.
Yes, Professor, we will ask questions at the end of your presentation. Thank you.
Okay. This is the trend of what's happening for sovereign wealth funds over a fairly long period of time. Again, they've had tremendous growth from this is what you have here. The red are the sovereign wealth funds, I'm sorry, are central banks, commodity, and the black are the sovereign wealth funds. The blue are public pension funds. Essentially, all of these are state-owned investment vehicles. Governments own a tremendous amount of wealth. Just in financial wealth of these three, it's $50 trillion now. It's 13 trillion for sovereign wealth funds, and you can see the black part in the middle there has been growing very steadily over the last since 2000. Surges when oil prices go up, as you might expect, but it's been fairly steady growth. The characteristics of the largest funds, the by far the largest, and almost always has been, is Norway's Global Pension Fund. Global Pension Fund, yeah, Government Global Pension Fund. That's what it is. So it's completely different from almost all of the other big funds in that it's very democratic country. It is completely transparent. It invests an endowment model of investing in that it's the classic publicly listed stocks, bonds with some real estate. All the others are owned. Most of the other big ones are non-democratic countries: China, Abu Dhabi, Kuwait, Saudi Arabia. Singapore, for 5 million people, has 2 very large funds. And then you can see down. There are other democratic countries: Australia, Korea, Turkey. But basically, the big ones are mostly authoritarian or non-democratic governments, especially many in the Middle East. The alternative assets on the side there, that's what they're invested in other than public assets, public stocks, and bonds. You can see Norway's is almost exclusively an endowment model of investing in public equities. All of the rest have some exposure, a fairly sizable exposure to alternative assets. This is the geographic distribution, and you can see on the left is going to be the Middle East and North Africa, overwhelmingly oil-based. This is where the largest ones are concentrated, other than Norway's oil-based. Again, looking at that very quickly, not a single democratic one jumps out. Saudi Arabia, Abu Dhabi, Kuwait, Qatar. These are all oil. Small population, oil countries generating a tremendous amount of current revenue that they need to invest internationally. The Asia, almost all the ones in Asia are Chinese or Singaporean, and again, Singapore's democratic, the others are not. They're almost all funded by export surpluses, government export surpluses. Small amount, other than Norway's relatively small amount in U.S. or Europe and elsewhere. So basically, it's Asia and the Middle East oil. The several attempts to classify, several attempts to classify sovereign wealth, and I'll go through it very quickly. Essentially, there's the first ones were stabilization funds. New territories, as I understand, certainly some of parts of the Canadian provinces, like this Oklahoma, are oil-based, resource-based, and they're boom and bust. During the good times, you want to put money away in a fund so that when prices crash, you have stabilization funds that you can use to cushion the economy. Others are savings funds, true savings funds that are investing for the future on the behalf of the population. Some of them are more or less development funds, which are targeted on developing the country and similar to development banks. And then you have public pension, which almost all governments have, and some of them are quite huge. The U.S., Japan, and several others are over $1 trillion each. It's fairly similar categorization in another paper that was a working paper recently, but I've been looking at this for 20 years, and in many ways, what I always default to is the democratic authoritarian choice between sovereign wealth funds, and basically, are they oil-based or export revenue-based? Those are the real defining features. Where and to what do they invest? They have a pretty good press in one sense, because most people think that we've heard something about sovereign wealth, think they basically invest in developing countries. They don't. They do like most institutional investors. They invest in safe Western markets, particularly the U.S., Britain, Canada for its size. So they invest in Western countries, mostly in equities, increasingly, as I'll show, private equity and other alternative assets, and in their local markets. They do relatively little true development lending to emerging markets or less developed countries. This is how the allocations of pensions of sovereign wealth funds have changed quite dramatically in 12 years. This has continued. You have the fraction that's allocated to private equity, including venture capital, which is probably a very big part of it, gone from 14% to 23%. I didn't highlight it, but the yellow there is infrastructure lending, and it's gone from 6% to 15%, 19%. I need to put my glasses on. What has really shrunk have been the allocations to public equity, the blue, and to public debt. I'm sorry, orange is public equity, blue is public debt. Both of those have contracted by 10 percentage points. So they've moved much more towards direct investing in private equity and infrastructure and other things, much less into public markets. This is the allocation to alternative assets by different funds. And you can see that very much Norway is a true outlier. It's still like what we call a foundation model or endowment model, just 60% equity, 40%, or 35% fixed income, 5% cash, something along those lines, relatively passive. The others have gone much more towards alternative asset allocation. This can be real estate, commodities, hedge funds, things like that. Again, most of the largest sovereign wealth funds allocate at least a quarter of their assets to alternatives, and they're by far the largest investors in this category, which I think is my next slide. Yes, this is of all private equity investors, and private equity now is about an $8 trillion total assets under management. It's grown hugely over the last 10 to 15 years. I teach a course in venture capital and private equity, and it has massively increased. Almost all of the 100 largest private equity investors are either sovereign wealth funds or public pension funds. Only 16 of the top 100 are, in fact, private insurance companies or university endowments. So these are state-owned investors have become hugely important in the markets, the financial markets generally, and particularly in private equity and venture capital. This just shows that they're the largest, the largest investors in venture capital, private equity-backed investments over the last 5 or 6 years, bigger than even corporates and other types of investors. I think what is the impact of the investment? And are they good investors? Do they create value? It turns out not particularly. I've been doing this for a long time, and I have to always resist the temptation to call them, big dumb capital, and that's cost me quite a few consulting gigs. But they've gotten better. But certainly in the early days and through the early 2010s, they were not particularly good investors, and they've professionalized at least to a degree. But this shows the returns compared to other. This just shows the returns. The blue are sovereign wealth funds. The red are public pension funds, and you can see some of them. New Zealand Super Fund, 12% compound annual return. Alaska, Texas, Mubadala is the Abu Dhabi's. Norway is at 10% compound annual return is quite good. But in general, public pension funds have outperformed the sovereign wealth funds. And the really big authoritarian pension funds of the Gulf don't even report. The GIC, they don't even disclose what IDEA's performance, they don't even disclose what it is, probably because it's quite bad. Academic research looking at sovereign wealth funds as investors. This is a kind of a leftover slide from just equity, private equity, but I'll show more generally what they have. One of our papers was published in one of our top 3 journals, the Review of Financial Studies, in 2015, where we basically compared when the sovereign wealth funds make an investment of this publicly disclosed investment in a listed company, U.S. international listed company, as you would expect. Anytime an investor makes a public equity investment, stock price goes up. It's considered good news. But what we showed by comparing sovereign wealth investing to other private institutional investors that are also disclosed, they're half as much. They're positive. So let me go straight to that. When we compare sovereign wealth funds to private direct investments in equity, sovereign wealth funds targets go up 2.5%. Other private investor targets go up by 5%. And that's what's summarized in this slide here. We call it the sovereign wealth fund discount. And most other studies have shown something quite similar. In general, they have some positive impact, but they're much less positive than truly private investors. Other recent research that's looked at it shows similar, looked at different things, but they don't tend to improve the corporate governance or the Tobin's Q, measure of total valuation of target firms. They don't particularly improve the corporate social CSR, corporate social responsibility. The other studies that do event studies show they have much lower returns than private, most other types of investors. So they don't harm as such. But there's very little evidence that they've had very significantly positive impact on their targets, and what impact they have is less than what private investors have had. So to summarize, and I hope I haven't gone too fast or not fast enough, the global importance of sovereign wealth has increased dramatically, but it can be overstated. The total financial assets in the world is something on the order of $350 trillion. So 13 trillion is not trivial, but it's certainly not dominant by any means. Insurance companies, banks, private investors have a much larger, much greater influence on global capital markets. They've grown, but they're still mostly passive investors. ADIA and Norway. The Norway fund has 400 employees, and they're managing $1.8 trillion. So even they try to be somewhat active, but they're constrained to basically be passive investors by and large. So what are the lessons of our research? This is particularly the public literature, the public discourse can be very unhinged is too strong a term, but can be heated. And basically what we show our evidence is that they're large, but they're not especially odd and they're certainly not frightening. They're operationally similar to most other types of institutional investors, and they're dwarfed by the private investors of the world. They're not homogeneous, but they do share common characteristics. At the same time, I recently heard a quote that, tongue in cheek, that if you've seen one sovereign wealth fund, you've seen one sovereign wealth fund. There are a lot of differences between them, but at the same time, there are many things that are in common. They are state-owned investment vehicles that with relatively small staffs but huge endowments. So they pursue what you kind of expect for that. Uh, they make politicized capital allocations, but only domestically. When they're operating abroad, they tend to be almost too passive. They're afraid of being charged with political influence, so they essentially become fans of management. So they're not particularly good as corporate governance agents. Now, in their home countries, they have free reign, and in many cases, they act on that. We just don't see the data because much of this is, unless it's a public acquisition and is announced, there's much that we don't, as financial economists, see of it. They're here to stay, and I've wrestled with this many times. The evidence shows that private institutional investors do a much better job. But at the same time, in those countries where, for a variety of reasons, private institutional investors just cannot flourish, where there's, if you're constrained to be by corrupt government or there's government capture, this is the second best organizational form. And I've become something of a, if not a fan, at least reconciled to them. Where there's no real alternative to sovereign funds, and so societies where the state plays a dominant economic role, these can in fact be viewed as the better than the alternatives, captured state-owned enterprises or other models. So again, that's my talk, and I have this for marketing purposes. These are the countries where I presented sovereign wealth fund research. So thank you very much for inviting me. I'm open to questions. I'll stop sharing.
Thank you, Professor. That was extremely speedy. Not bad though. I was able to follow you, and I'm not a financial person, and I was able to follow you very well. So thank you for that.
Okay.
Committee, I'll ask if you have any questions. Please make it known right now. Mr. Rogers, go right ahead.
Sure. Thank you, Madam Chair, and thank you for the presentation. Certainly very interesting. We are looking, obviously, our Heritage Fund is nowhere near what these sovereign wealth funds are. We're kind of just a blip when you look at what you've been studying. But one of the things we're looking at here, and I'm not sure if this is in your wheelhouse, but we're looking at kind of how our investment strategy, how we approach our investment strategy here. You spoke about some of these sovereign wealth funds are in risky investment, and obviously with public funds, we're very risk adverse, and some of us may say a little too risk adverse. So I'm just wondering, I guess, what you've seen, if you've seen any, in your studies, any funds that are more similar along the line of a heritage fund, and then kind of what kind of strategies are you seeing there, like versus, I guess, treasury bills or bonds versus private equity, and yeah, maybe I'll leave it at that. If there's any advice or any comment you would make on that, thank you.
Thank you,
sir. Mr. Rogers. Oh, sorry. Just for this is our procedure. The questions and answers go through the chair, so not a problem. Thank you, Mr. Rogers, and over to you, Professor. Thank you.
Okay, well, Madam Chairman, thank you also for Mr. Rogers, Assemblyman Rogers, I assume. Very good question. I read as much as I could find about the Heritage Fund and about the allocation, the original setup, how it is invested. Clearly, it is following a political objective function. That's what it was set up. It has support for Native peoples and atonement for the past. So this is not uncommon. For national funds, it's less common, but for domestic funds or provincial funds, yes, you see this fairly frequently. To the best that I can see, it looks like your fund is about $100 million, but I couldn't get a very clear post on that. If that's the case, and essentially you're not going to transform even a relatively small provincial economy with $100 million. Essentially, the finance professor, and let me just briefly say, when I started the PhD program in 1982, the Dow Jones Industrial Average in the United States was 775. It is now 45,000. So in the space of one less than complete career, you've had stock markets around the world increase almost 50-fold. So in many ways, the danger for investment is to be too conservative and to not invest in equity. If you want to expose, again, subject to political constraint, I understand this, but you want to be exposed to the dynamic business model of a country like Canada. To the extent that I can make general comments, yes, I would encourage reliance on increasing allocations to equity, subject to a constraint, and yeah, I'll just leave it at that. Yes, in general, the danger is taking too little risk rather than taking more.
Thank you. Thank you, Professor. Follow-up, Mr. Rogers?
Sure. Thank you, Madam Chair. Yeah, I appreciate that, and certainly, we appreciate it as public funds, and you don't want to lay it all out there to risk. But certainly, if you're going to make this money work, I think putting a serious portion of it into equities obviously is where you're going to make that money. Have you seen, and obviously in some of the countries I know you've put on your presentation, probably not a lot. Have you seen much, I guess, with some of these wealth funds looking at ethical investing at all, or is that just kind of out the window and we put it in where we're going to make the most money? Thank you, Madam Chair.
Thank you, Mr. Rogers. Professor?
Yes. In fact, I was invited by a co-author on other papers to join a paper today on sovereign wealth fund and corporate social responsibility. Yes, they have been leaders, at least at a headline level of supporting ethical investing, sustainable investing, corporate social responsibility. The DEI has been mostly a North American phenomena, so they haven't, and they don't really have the employment to do that. But yes, they have been very active as ethical investors. It's at the same time, remember, most of them are oil funds. 2/3 of the money is oil. So ultimately, it's the original founder of OPEC called oil the devil's excrement, and if you're a country, it's good to have it, but it also has real costs to have oil, particularly if you're a non-democratic country. And in fact, having oil retards democracy. But they're within the constructs that these are oil-based funds, or these are Chinese funds, which are the biggest polluter in the world. They talk a good game. At some margin, they have actually done it. The study that I joined today shows that the CSR improves. Now, this would be one of the first studies to show this, but the corporate social responsibility improves. The ethical, though, I mean, the other side of this, and I may join there's a lawsuit against the big three investment funds, BlackRock, the others, by several red state attorney generals, saying that they pushing for sustainable investing for coal companies basically cost coal company shareholders significant returns. And that's unquestionably true. Actually, if I do join it, and if it does go forward, I'll actually be for the defendants, the companies, the asset company. But it is very much an open question. If you do impact investing, if you do ethical investing, it's now fairly unambiguous. There is a cost to this. You have a lower return, financial return, if you follow an ethical investment strategy. And it's in many ways, it's finances worship. Finance is executing your values rather than your pocketbook. So as a public fund, if this is the will of your democratic society, then yes, you will be expected to do a certain amount of ethical, sustainable investing. You just have to be cognizant of the fact that there's no free lunch in economics. And if you do, you'll probably over time have a lower return. Thank you, Madam Chair.
Thank you, Professor. Next on my list, I have MLA Morse.
Thank you, and thanks to the professor for the presentation. I guess my question, I mean, you're sort of noting the difference between sovereign wealth funds and private equity funds and how the private equity funds tend to outperform them. But I mean, the two have fairly different goals in mind. I mean, sovereign wealth funds are generally about kind of taking money that's come from sort of a collective resource, a resource owned by a country or a state or a province in this case, or territory as we call it, um, and sort of investing that money and ensuring that the money has longevity and that future generations can benefit from it. So they do have a bit of a different purpose. I guess what I would ask, I mean, I think that probably there'd be people that would argue that a sovereign wealth fund shouldn't necessarily behave like a private equity firm, but certainly having high returns is good for the fund and good for the people who benefit from it. I guess to get to a question, I would just ask, how would you recommend going about kind of maximizing returns, but also protecting principal and ensuring that the fund operates in a way that would bear public scrutiny? Because of course, high risk investing is great until there's a huge market correction and half the value of your fund disappears overnight. We don't want to be in a situation like that as a government either. So I'm kind of curious how we find the balance, and if you have kind of some advice for us as we look at our own fund.
Thank you,
Madam
Mr.
Chair, should I?
Thank you, Mr. Morse. Professor, to you.
Yes, again, excellent question. And it has been wrestled with by every fund that's been set up. In some margin, I might take a bit issue with it that they're not that different. I mean, they are set up deliberately separate from your central bank reserves. They are set up to earn a long-term commercial return by investing in risky assets. As I kind of alluded to, in long-term investing, the great danger is being too conservative. Again, you have not gotten a 50x return by investing in treasury bills or bonds or any. I mean, this is well established. You're right. You certainly have the ups and downs. In 2009, with the crash, the stock market lost over 50% of its value in very few months. Now, it then tripled within a few years after that. The other thing to possibly keep in mind is that sovereign wealth funds, this is one of the things that they have going for them, that it essentially is different from private equity. Private equity has a 10-year horizon. They have to start a fund every year and liquidate the fund at the end of 10 years. Sovereign wealth funds do not. Pension funds do not. They have a very long-term horizon. Pension funds, by definition, you're investing for people 30 years in the future to be able to retire. With pension funds, I mean, sovereign wealth funds and public pension funds, there really is no retirement date. It's very far in the future. You can take risk if over long periods of time it tends to even out. In many ways, what every fund is set up, the big ones that were set up, wrestles with the following question. You're Abu Dhabi. Your problem. Your challenge is that you have 400,000 Emirati citizens. You produce 2 million barrels of oil a day, so several $100 million worth of revenue every day. You have to invest that internationally. Even Norway could not invest domestically, or you'd have the mother of all asset bubbles. So you have to invest long term. You have to invest internationally. You can't buy stocks. You can't buy companies. Whereas private equity, they can. They're perfectly welcome to come in, buy any company they want. You can imagine if the Saudi Arabia Public Investment Fund tried to buy a flagship Canadian company or Boeing or anything like that. They're politically constrained to make international investments. I'm sorry, did you have a follow-on question, or Madam Chair, should I stop?
Thank you, Professor. Mr. Morse?
I mean, I was happy to let the professor go, but yeah, just I guess to add a follow-up. I mean, if the professor has examples for us of kind of funds that have done a good job of maximizing benefits, I think that there's a reason to have a certain amount of a conservative risk profile, but I think the professor's point is taken, and I think an argument could be made that the NWT fund is currently too conservative because it hasn't been achieving the returns that you'd expect to see from a well-managed fund. So certainly, I think there's a balance to be found. But if you have an example for us, and certainly maybe some
Yes.
governance tips, because that's really what we're looking here is at the governance of our fund and how it's governed. And if there's examples you can give of places that we could be looking for well-governed funds that are quite successful, it would certainly help us with our review. Thanks.
Thank you, Emily Morse. I have some thoughts on that as well, but I'll wait to see what the professor has to say. Thank you.
Thank you, Madam Chair. Yes, it's certainly the flagship one and the gold standard is the Norway Fund, set up in the with the as soon as the North Sea oil fields. The problem was, again, you're a small company, you're going to have this finite resource for a few years that is going to be absolutely immense. How do you invest that as a state? Now, Britain had the same thing. They shared the fed. There was a North Sea, was shared the field. In Britain, they were privately owned oil companies that the money flew through to shareholders like that and to the state to a degree. Um, Again, even with oil, and we digress briefly, with oil, the perception is that private oil companies in the US and other countries escape taxation. Governments tax oil in the West comprehensively at every level. So you don't necessarily need to own an oil company. Now, Norway had the state oil company. They were transparent from the very start. They have followed this endowment model, which is very low cost to given their scale. So the fees are very, very small compared to private equity, many other fees. So they have been the class act. And other, the Korea Fund, Australia Fund, New Zealand funds that I showed back there, all the democratic country funds are very transparent. And even when they go into private equity or other alternative assets, they're transparent. You know about it. They're well governed. They're subject to political oversight as you have in any democratic society. But I mean, certainly the Norway Fund is the best overall. Temasek of the Singapore, there's government investment fund in Temasek. Temasek has this very high return. It's very transparent. They evolved out of they were several state-owned enterprises, and when defenders of state ownership need examples, I always point to Singapore because they have done an incredible job at state ownership and state management. That one has been very good. The other one, the government investment fund, is not transparent. It is disclosed only to the president of Singapore. So yes, you have several funds that have performed extremely well. I mean, I should know more about the Canadian funds, but what I know about them, they're very much open, transparent. They invest in a lot of equity, just like you would expect. The Alaska Fund is very transparent. But if you're looking for two, particularly that a handful that you as a model, start with the Norway Fund. It's the biggest, most transparent. Then also the New Zealand and Australian Fund are would be very quite similar to Canadian in many way, as very well managed funds that make a balance between equity and fixed income. Madam Chair, you had a question as well.
Yes, thank you for that. I was thinking about the governance piece, but maybe a little bit differently than MLA Morse. You spoke in your presentation about different categories of funds. You broke them up into stabilization, savings, development, or strategic, and public pension. And I was wondering if you have any examples that you have seen in your research of how a fund that maybe categorized themselves or fit into one of those groups then perhaps changed tact and became a different fund, and if you have any thoughts on that subject. Thank you, Professor.
Thank you, Madam Chair. That's very good question. Again, this is the quick answer is that many, if not most of them, have evolved. If you look historically, most of them started out essentially as stabilization funds to one degree or another. Kuwait originally, they have a finite model. That was when it was a British protectorate in the 1950s that they started out. Many of the funds, the Alaska Fund was certainly a stabilization fund. Many of them started out as stabilization fund, and as they grew larger and the assets under management became quite large, they tended to diversify and evolve into long-term investments. Now, one of the things I didn't mention earlier, and I meant to, is that you hear this fairly frequently with long-term investors, but particularly with sovereign wealth funds, is illiquidity premium. In simple terms, if you one of the investors like owning publicly traded stocks and bonds is that they can buy in and sell anytime they want. It's a liquidity benefit, and of course, they are willing to sacrifice a certain amount of return to have that liquidity benefit. Sovereign wealth funds don't need that. Norway's not going to need its money for decades, so they can invest in illiquid, thinly traded, even private equity that and capture that illiquidity premium. So in many ways, they have access to a larger pool of capital, and they are not pushed to be short-term investors at all. So they seek a long-term, stable, diversified international return for the benefit of their citizenry. Did that answer your question, Madam Chair?
Yes, thanks. So thank you very much, Professor Megginson. At this time, I don't believe we have any further questions from members, but I did want to give you the opportunity to make a closing statement if you wish, or if you have any further thoughts that you'd like to share with committee at this time.
Thank you very much for inviting me. I enjoyed preparing for this. I enjoyed the presentation. I would be presumptuous to give you any more specific advice, but I would be happy to talk to you any other time in the future. But again, I'll close just by thanking you for inviting me.
We're very pleased that you could join us, and I'm certain that if we have further questions, our staff will be in touch. So with that, thank you once more, and this will conclude our public portion of our meeting. Have a great evening. Thank you, sir.
You too.